folks. Welcome back to yet another episode of Yash the Bill's Book Club. The book we are reviewing today is Coffee Can Investing by Saurabh Mukherjee, Rakshit Ranjan, and Pranab Unyal. It's a great book about investing, more focused on the Indian context, but still gives you a brief overview of basics of investing. So let's see what is stored in this book on the other side of this video. So the book focuses more on equity, which means stocks, bonds, mutual funds, and it sort of discourages real estate as a form of investment to make better returns. More on that towards the end of the video, but let's focus on the the core points about equity. So the first point: buy quality and ignore the price noise. Great businesses may look expensive, but compounding rewards quality, not bargains. Second point: hold for very long periods. A 10 to 15-year holding period allows earning growths to overwhelm volatility. Third point: return on capital employed, ROCE, is the North Star. High and sustained returns on capital signals a durable competitive advantage. Fourth point: low debt equals longevity. Companies with clean balance sheets survive downturns and compound smoothly. The fifth point: consistency beats excitement. Predictable earning growth outperform flashy but erratic performance. The sixth point may sound counterintuitive, but the point is doing nothing is a strategy. Inactivity, once the right stocks are chosen, is a powerful edge. Seventh point: let winners run. Most returns are created by a few exceptional stocks held uninterrupted. The eighth point: avoid behavioral mistakes. Very crucial point. Fear, greed, and overconfidence destroy more returns than bad stock selection. Ninth point: concentrated, not cluttered. A focused portfolio of 10 to 15 businesses, elite businesses, is sufficient. The 10th point: compounding needs patience. Time is the most undervalued asset in investing. Remember, it is not about timing the market, it is time in the market. Now let's move towards why the author is for equities or inclined towards equities. Because equities compound transparently. The earnings, the ROAS, and cash flows are measurable and scalable. The liquidity with equities is high. You can enter, exit, rebalance without any friction. It has a very low transaction cost, especially via mutual funds or ETFs, exchange traded funds. It also has tax efficiency over time. Long-term equity rewards patience. And then there is also data-backed evidence. Indian equities have outperformed most asset classes over time. And then why is the author discouraging real estate as a form of investment, that is? It's got poor compounding. Prices do rise, but cash flows rarely scale meaningfully. What it means is that one may see that my property has quadrupled in last 20 years since the time I bought it. Yes, it has become 4 times the value, but if you see compounded annual return wise, it's just 8%. Whereas equities invested for the same time will give you 16 times the returns, which is annual compounding of around 15%. Other problem with real estate is got high friction costs. Stamp duty, registration, brokerage, maintenance. The third problem: illiquidity. It's not a very liquid asset in the sense that if I want a certain amount right now, I cannot sell one room of my house and be like, okay, let me get that money. The other problem is it takes time to sell. And often when you want to really sell it, you will end up selling it at a discount. Another problem, it's got opaque pricing. There is no transparent market or continuous price recovery. And then there is a leverage risk. The debt magnifies downside during downturns. So finally, I'll end this video with these couple of statements from the book. It is important to link your investment style with your financial objectives. And that is why having goal-based investment is very, very important. Otherwise, you will end up either taking unnecessary risks or undershooting your financial goals. The essential link between your investment style and your financial objectives is made through financial planning. That's all for today. I'll see you in the next one. Before I go, I would like to give a couple of disclaimers. One, I am no financial guru or advisor. These are just the thoughts from this book, which is very well written. This book also resonates with my understanding of finances, whereby real estate are not that good of an asset as opposed to equities. So yes, these are my thoughts, the author's thoughts probably. But by no means I'm saying that you should be discouraged. The whole essence about this is to have proper financial planning based on your goals and objectives. Thank you. See you in the next one. Take care.